This screencast is looking at Summer 17 question 2, focused particularly on the calculation of internal rate of return, also known as IRR, and dealing with sensitivity analysis. So both things are looking at Pillar 2, investment appraisal in CAP1 finance. So again, I'm assuming you've read through the question. You might even attempted to lay out the cash flow table. We're not going to really look at part A, which is really to do with cash flow, cash management, which is part of working capital, and nice 6 marks that you should have done first and get out of the way. Right, so internal, external influences on cash, that is dealing with session 9, which is cash management. So we'll see here, even in Summer 17, there was 2 areas combined. Part B, internal rate of return, and Part C, sensitivity analysis, they were investment appraisal, whereas this was working capital. And expect to see that going forward is what we call the combined questions, where you have questions from more than one pillar in the exam. So I've assumed you've read through the question. You essentially have a Harper company who's looking to build 5 holiday cottages. So again, a lot of students miss that. There's going to be 5 of them, so that's important in terms of your calculations. Right, so there's going to be 5 different ones. And we have a couple of things here. So it's essentially set up like an NPV question. The only thing is here, you're not asked to do an NPV, you're asked to do an IRR. But of course, what we know is you're going to be doing NPV as part of IRR. Right? So to calculate IRR, we need 2 things. Right? We have the formula. So if we go back here, just bear with me a second, and I'll get the formula. You're given the formula in the notes. Find it here. This one here. So we're just going to take that. So I'm just going to snip that to bring it in. So you have the formula. So you know what you have to do. You know what you need. But what we need to do now is we need to get 2 NPVs then. We need to get a rate 1 with an NPV 1 and a rate 2 with an NPV 2. Right, so that's your basic in terms of how IRR works. We're told in the question the cost of capital is 7%. So we'll use that as one of them. That's a logical starting point, because why would they give it to it otherwise? Let's use 7%. So what we now need is a cash flow table. So similar to NPV, we need to get the cash flows for the relevant years based on the information provided. And remember, when you're doing these out, if you're leaving out something or you're bringing in something, always articulate why. Is it a sunk cost? Is it an opportunity cost? Is it relevant? Is it irrelevant? If you just leave it out without explaining, you won't get the marks. But you need to make sure you understand and explain to the examiner why you're bringing in or leaving out something. In this question, we're told, just so we'll get the number of years is always the starting point, we're told it's a 4-year life. So I've assumed you've read through the project, but we see here, they're going to sell the holiday village at the end of year 4. So you're going to have 5 columns. Year 0, year 1, year 2, year 3, year 4, and year 5. Or 4, should I say. So 5 columns, 4 and year 0. Alright, so that's the first starting point, is to put it in like that. That's the years. Now we get the cash flows. So we just work down through bullet by bullet, and you try and include it or remove it. That's entirely up to depending what your understanding of relevant costs are. So first one is market research that has been incurred and already paid. So it's important, that is a sunk cost. If you left it out, you wouldn't get marks. You need to write down the bottom of the page, sunk cost left out, or market research cost left out, because it is sunk cost. It is not relevant. That's your first point. So we've left that out, and we've explained why we did. Site will be bought for 360 immediately. So I'm just going to put in here, site cost minus 360. So we're just going to do it in dropping the 3 zeros, just to make it easier to see. So site cost is relevant, paid immediately, therefore it's year 0. So put in all the easier ones first. We then have further 730,000 to build the cottages, 5 of them, 30% immediately, remaining at the end of year 1. So we call this build cost. So the build cost is split 30% of 730 immediately, which is times 0, and 70% of 730 at the end of year 1. So it's 219 initially, 511 at the end of year 1. So a lot of these are straightforward, but get the marks. Get them easy and then worry about the calculations at the end, because you're constantly building marks as you go along. So it looks like we're building the cottages for the first year. So we're told here you're going to rent out the cottages then, fully operational at the start of year 2. So from year 2 to year 4, we're going to have income. Each cottage is rented out on a weekly basis. So we call this rental income of 750 per cottage. each cottage will be occupied for 40 weeks of the year. So it's only in year 2, it'll be 750 times 40 weeks, and this is important, times 5. Well, because you have 5 cottages, you multiply by 5. So that is, now I'm dividing by 1,000 to get in zeros, 150,000. Now, really, you'd want to show that to the examiner. So what you might do there is, you might reference there, working 1. To show the examiner, this is where it's coming from. It's 5 cottages times 40 weeks a year times 750, and I'm dividing by 1,000 to drop the zeros. Now, it's 5% increase each year, so it'll be 5% higher in year 3, 158, and it'll be 5% higher in year 4, 165. Now, there's a small bit of rounding here. If you actually go out to the decimal, you might get 157.5, but that's fine. Right? You're not going to be penalized for that. Just show the examiner in a working, this is my core calculation, and then I'm growing that by 5% and that by 5%. Because we're told here, we're assuming 40 weeks a year. That doesn't change year on year. Right? So we're working as we go along, and if you wanted to show the working separately, that's perfect, and you'll get your marks. The cost then, the running cost. So if you want to put working 2, you can. I'm just going to show it in Excel, just for the ease of the video. Each cottage will amount to €100 in the weeks of occupancy and €40 in the non-occupancy. Right, so that's important. We have 40 weeks of occupancy. We have 12 weeks of non-occupancy. So it's going to be a minus 40 times 100 minus 12 times 40. So it's 40 weeks that's occupied at €100 then weeks. And then it's 12 weeks, because there's 52 weeks in a year, and €40 on the weeks not occupied. And of course, what I have to do, because I'm going this way, is I'm dividing by 1,000. Dividing by 1,000, which is minus 4. Just double check my calculations there. So minus 40 times 100. And what I've forgotten to do there, of course, is I need to multiply by 5. Because there's 5 cottages. I mean, that's one thing that a lot of students forgot, why I highlighted myself even at the start, is a lot of students did it for 1 cottage and then put those figures in. So actually it was minus 22,000 there rather than minus 4.5. So watch out for that. It is 5 cottages. 40 weeks of the year it'll cost you 100, 12 weeks of the year it'll cost you 40, and there's 5 cottages there. And that does not change for each of the years. So that does not change for each of the years. And again, if you just want to match it to the solution, just so you can see, it's slightly more accurate if you go to 1 decimal. But you're not going to lose many marks, if at all, if you round to that, as long as you show where they're coming from. Right, so that's dealt with this bullet point. So you can see here, there's no inflation, you're told costs remain constant. So it's nice, take each bullet point as they come. If you can't do one, skip on and come back to it. So we're now in this bullet point here. Fixed cost to Holiday Village, 80,000, beginning year 2. It has been calculated 30% is the overhead cost projected allocated to the project by Harper. So the head office has allocated 30%, and it's important you put a little bullet point about that. That element is irrelevant. That would be incurred anyway, so you're only going to show a cost of 80 times 70%. Because your argument is 30% of that would be, it's irrelevant because it's not incremental. Right, it's not an incremental cost, therefore it's not relevant. But get those easy marks as you go through. So it's minus 56 each year. There's no inflation. Right, so that was tricky, but it's important that you put a bit of practice in, that you understand exactly what they're asking you. Very similar if it was an NPV question. We're going to be doing NPV as part of the IRR anyway. The last one then is Harper intends to sell the village, so we'll call this the disposal. It's going to sell it at the end of year 4, so 1650. But you're going to have CGT. So you're going to have capital gains tax in the year of disposal of 25%. So capital gain tax of 25%. So it's 1650 times 0.25, which is a minus 413, or essentially it's 41.25. Now, technically, I'm sure when you get on to do tax, you wouldn't be disposed just on the proceeds. It'd be the difference between the proceeds and the cost. But for this perspective, just assume it's 25% payable on the sales proceeds. That's technically not how you do it, but for CAP1 finance, that's perfect. And always do what you're told in the paper. Right, so that's all our costing so far and our proceeds. You're told we'll use some cash to pay for the investment, so all this money up front, and they'll take out a 200 grand loan, which will pay interest at 20%, or 4% should I say. Now remember, this is an irrelevant cost. You should never have finance costs or finance cash flows, so loan drawdown or loan repayment, in the cash flow table, because that will double count it. Your discount rate, which is the 7%, incorporates in that interest cost. So that's another irrelevant cost. But to get those marks, so to get the marks for the sunk cost here, to get the marks for the 30% it's irrelevant here, and to get the marks for the interest, you need to articulate it. So write it down why exactly you're leaving it out or you're putting it in. So the last thing we have to do is tax. So we need to calculate tax. So I'll come down and show you how you calculate tax, working 3. How we do that is we need to get the taxable profits. We have no capital allowances here, so we didn't need to worry about capital allowances. Our taxable profits are nil in year 1 because we didn't make any income. We had no expenses. Our taxable profits in year 2 are 150. Take off your running costs, take off the fixed cost. So it's only the day-to-day expenditure that you bring in. It's only the day-to-day expenditure. Same for the other years. So 71, 79, and 86. You do not bring in the investments. You do not bring in the disposal because that has its own tax. So the taxable profits, and you calculate your tax at 20%. And we're told tax is paid in the year profits arise. So we don't have to do an extra year lag. It's just 20% and minus 71 times 0.2. So 14, 15, and 17. 14.3, 15.8, and 17.3, 17.4 when you round. So that's important that you keep it separate. Make sure you only consider particularly complicated when there's working capital or whatnot in there. We don't have that. So tax is 14.3, 15.8, and 17.4. So again, if you have those down, stop the screencast now and go on and see can you do the whole question out. We've all the cash flows done now. So you tot them up. What I'll do is I'll tot them up quickly for you, just to give you the cash flows. So I'll just do them quickly in Excel. It's the beauty of Excel. I know it'll take a bit longer for you to do them in the exam. So there's your cash flow profile. Right, you're just adding up the cash flows. You have them all done in the table. You've got your marks for the ones that shouldn't be in there. And this is what we're going to use to calculate our IRR. Right, so what I want you to do is calculate. You need a rate 1, NPV 1. Rate 1, that is going to be 7%. Right, so we'll keep it close to the solution just so you can map back. So I want you to calculate NPV. What is the NPV at 7%? You can use the tables or you can use the formula. That is fine. Right. What I also want you to do then is, we'll come on to it, we'll calculate another NPV. So the first thing is calculate the net present value at 7%. If you want to use the tables, that's fine. We have the tables here. You get 7% and you use these discount factors. So discount factor for time 0 is always 1. There's no discount. Then it's 0.935. So we can see them here. 0.935, 0.873, 0.816, and 0.763. So that can be the easiest one to do. You take them from the tables, which will be in the back of your exam paper. Always take the present value tables. 7% is what we're using. Right. So we now get our present value by multiplying the cash flow by the discount factor. So minus 579 times 1 is still minus 579. Then you multiply across. So again, I'm just going through the calculations. You can spend a bit more time if you want to practice, but it's each cash flow times the discount factor. If you want to do the formula, that's fine. So for example, you might get a slightly different answer. If we were doing here the formula, it would be 57.3 divided by 1.07 to the power of, in this case, 2 years. So you get 50. You get fairly close to it. So it might be a small rounding error, but nothing major. So either way is fine. You'll get full marks. To get your net present value then, you add them up. So it's all the present values. And the net present value is 42.2. So it's positive. So we now have our first pair. We have the R to be 7%. And we have the NPV to be 42.2. So we've essentially, when you're asked IRR, you're actually doing NPV as well. The reason we took the 7% is they gave us a guide in the question. Why not use that one as a starting point? Sometimes you might just start randomly at 10%. But we were given a guide, so why not use that? So we now know using this discount rate is a positive NPV. Ideally, when you're using this formula, you want one positive NPV, one negative NPV. That will allow you get an accurate idea of where the profile crosses the x-axis, which is when the NPV is 0. Now, judging on this, I always tell students, look, judge how big the NPV is relative to the investment. It's not that big, it's less than 10%. So you don't have to go a big increase. Why are we going an increase? Because the higher the discount rate, the lower the present value. So if it's positive, we need to go higher. We're going to go NPV at 10%. We don't need to go that high because the NPV is marginal relative to the size of the investment up front. That's the judge I always make. If you're unsure, go out to 15%. You're not going to be penalized for that, but just make sure. You don't want to be doing it a third time. So net present value 10%. Let's go to the tables, get the discount factors. So it's always 1 for year 0. Now it's 0.909. Oh, that's the wrong one. Get the right one. 0.909, 0.826, you can see them here, the very right column, 0.826, 0.751, and 0.683. You can use the tables or you can use the formula, either or is acceptable. So we now get the present value, which is the same as before. Just make sure you take the right calculation or cash flows. It's minus 579 times your discount factor. That's year 1. And you run those across. Right, I'll just tidy those up. So, and you get your net present value, which is the sum of all the present values. So I know I'm going a small bit quicker, but again, so it's for you to go on. You're just getting the discount factor. We took 10% because we want it to be a negative NPV, and we said we don't need to go that far. Or if you want to be safe, you might go to 15%. You then multiply the cash flow that you calculate in the table by the discount factor and get the net present value. So this is going to be R2, this is NPV2, this is R1, and NPV1. Your R1 is always the lower discount rate. To make calculations easier, your R1 is always the lower discount rate, and that's 10%. So you now actually have what you need for the IRR. So IRR is a bit more involved requirement because you need to do 2 NPVs first. So they're actually, the examiner is killing 2 birds with 1 stone. Gets you to NPV and IRR. So let's bring down this formula down here. And what we need to get now is we have rate 1, so your IRR, that we're going to calculate, is rate 1, which in this case is 0.07, plus, on the top, we have NPV1, which is 42.2, times 10% minus 7, and on the bottom, you have NPV1, which is 42.2. Now be very careful here. You're minusing NPV2, a minus minus becomes a plus, 55.9. So that's a key thing to watch out for there. When you have a minus minus, as you usually do in these types of questions, that will become a plus. So working that out, it will be 0.07 plus, we'll do this out, 42.2 times 3% divided by 42.2 plus 55.9. Just do that formula out. And therefore the IRR is 7% plus 1.2%, which is 8.2%, 8.3% if rounded. So we're saying the actual return in that project is 8.3%. The IRR is 8.3. Well, pretty tricky. You have to do two NPVs first and then apply the formula. But remember, the formula was given in the notes. All you need to know is what the cash flows were and how to figure out which side you should go. You should always have one positive NPV, one negative NPV. So we're saying there, although the cost of capital is 7%, the actual return on the project is 8.3. That's why the NPV is positive at 7%. You would accept this project because the actual return is higher than the hurdle rate, which is the cost of capital. Right, so that would have got you 9% of your paper. Whether or not the project is worthwhile, it is, because it's in excess of the 7% required rate of return. Now, the next part is a tricky one often for students, is sensitivity analysis. So this is where any investment appraisal, you have uncertain inputs. You're not sure what the cash flows will be, you're not sure what the income will be, the cost will be, etc. So what you're trying to do is you're trying to move different variables, and for sensitivity analysis you move one variable at a time, and you see how much you can move it before it becomes, would cease to become worthwhile. Right, so remember, it's currently worthwhile to the tune of 42,000 in PV. So when we're doing sensitivity analysis, there's three types. Right? There's three types of sensitivity analysis. The one is a one-off cash flow, such as here, for example, it will be the site cost. This is a relatively straightforward one. It's a one-off cash flow up front, and we'll talk to you how you might do that. It's not asked, but it's a useful one nonetheless. So the site cost there will be one-off. The second one thing is an ongoing cash flow, which you're asked here is the running costs. The difficulty with these are they're more than 1 year. So we have to account for their multi-period, 22.4 over 3 years, not just a one-off. So it kind of complicates how we go about it. And the final one then is your discount factor. 3 is your discount factor. How sensitive is the discount factor, or sensitive is the NPV, the result, to the discount factor? And we've kind of touched on that already, so we'll come back to that at the end. So just to talk through each individually, the one-off firstly, how we always get the sensitivity for the first two is the sensitivity in percentage form is the NPV of the project over the present value of the variable. Right, that's a formula you're going to need to know. To calculate the sensitivity, you put the NPV of the project, which in our case here is 42.2, because we've calculated, we needed the 42.2, which is a 7%, divided by the present value of the variable, which here is 360. Why it's easy here is because it's on one cost cash flow figure and it's times 0. So that is the present value already. So we put that over 360. So that is 11.7%, or 12% if you're round. So what does that mean? Now, we weren't asked this one, but it's useful to understand. When you have a one-off variable, typically in times 0, it's pretty straightforward. You get the net present value divided by the present value of the site cost. So what's that saying? It's saying that the site cost can go up by 11.7% before the NPV turns negative. That's what it means. So it means the site cost can go up by 12% before this project ceases to be worthwhile. And that's a very useful one to know, particularly, for example, now we have rising property prices. We know the site cost can go up by 1.117. So it's going up by 11.7%. It can go up to 402. So it can go up to 402. And just for example, let's prove that. Now, because I have an Excel done, it'll all flow through. But if I put this to minus 402 instead, let's see what happens our NPV down here. Now, you don't have the benefit of doing this in pen and paper, but you understand, if I move that to 402, my NPV is 0. Now, just for rounding. That's what that formula is trying to tell you. How sensitive is your NPV to changing the variables? The first one, changing the site cost, is pretty straightforward. So just, if you're going from 360 to 402, or 2.1 or whatnot, you're just about break even then. So that's your first port of call. The problem now with the second one is an ongoing cost. is it's still the exact same formula. The problem is here to get the present value of the variable. This is the tricky bit here. Hopefully it'll give me a different color. That you have to do a little calculation. We need to get the present value of the running costs. So we have 0, 1, 0, 1, 2, 3, and 4. So we need to say, what's the present value of all those running costs? Because they're not n times 0. What we have instead is, we have 22.4 in year 2, year 3, and year 4. So we'll bring down those as cash flows. 22.4. I'll just bring them back in just to make it easier on the... I can widen this a bit. So, and we get the present value at 7%, because that is the discount rate, that's the cost of capital. So you use the cost of capital in this case, that's why you're given in the question. So we're just going to bring these discount factors down again, as we've done before. So this was tricky if you didn't know what you were doing. And we get the present value. This is obviously 0 and 0 because you have no cash flows. But for these then, the 22.4 times 0.873, 22.4 times 0.816, and times 0.763. So for the life of the project, although the full running costs, if we add them up, are about 67,000 euro, the present value of them in today's money will be about 55,000. So that's what we're interested in when we're doing sensitivity analysis. It's 54.9. 54.9. And we do the same calculation as before. We get the present, or the NPV, which is 42.2, and we divide by the present value. You don't need the negative figure here. It's 54.9. So you don't need to interpret it as a negative or positive percentage. You just divide by 54.9, and that tells you about 77%. 76.9%. So what does that mean? That means that the running costs can go up by 76.9% before the project would be loss-making. So it can go from 22.4 up to 1.769 up to 39.6. But remember, that's not just a one-off one. It's in year 2, year 3, and year 4. Because if we just did it with the 67, we wouldn't account for the fact that this is worth less in the subsequent years. So we need to account for the time value of money. So let's see, can we prove that? Let's see, if we do change it to 39.62, will the NPV break even? So I know you don't have the benefit of this in pen and paper, but for study purposes, it's very useful. So let's change this. Remember, we'll just make these equal to it, so it'll all change at once. So they're all flat. Makes it straightforward. I'm going to change this to, I've forgotten myself, 39.62. So minus, let's go down and make sure we can see the NPV. So keep an eye here, the 42, minus 39.62. 39.6, 39.6. Now, so what you can see here is the NPV is still at 8.4, and the main reason is there, we haven't accounted for tax. So if we ignore tax in the question, we've said that the NPV would fall by 42. But because we have extra expenses, that's valuable for tax, so it's actually a net benefit. Right, so you don't need to complicate too much for yourself about that, but ignoring the complication of tax, that will come back exactly to 0. But because we have tax involved, if we increased our expenses, it'll slightly offset it here. So actually, the 42.2 that fell, 20% of that, that's where the 8 comes from. So from your perspective, all you need to know is, if we increased it by, in this case, 17 or 77%, 76.9, that's where we break even. And that's what'll get you full marks in the exam. You don't need to go back and prove it, but it's important just to understand the dynamics and how it actually works in practice. So the two main type ones you'll be asked are a one-off one, how you calculate it, or an ongoing cash flow one. It could be revenue, so you go back up there, you could be asked to the revenue one, you could be asked the fixed cost one. You do the same approach because it's an annual cash flow, not a once-off. Now the last one caught a lot of students out, surprisingly, is the discount factor. If you're ever asked the sensitivity to the discount factor, what they're asking you, as in here, they're asking what the IRR is. We've already done the IRR, so there's actually very little marks here. There's probably 4 marks going for this one, 1 mark going here. What you needed to realize was The IRR in this project is 8.3. The current cost of capital is 7%. So I mean the sensitivity analysis is 1.3%. i.e. the discount factor or the cost of capital could increase by 1.3% before the project will become break-even. So that was a little tricky one more than anything. But that's a popular one with the examiner, so do pay attention to that in prior papers. The discount factor, so I call discount factor can rise by 1.3%, i.e. 8.3% less 7% before the project becomes break-even. And that's a key point that you'll understand, that you know what the discount factor sensitivity is. It's comparing the current cost of capital to the IRR. So it was a good question covering sensitivity analysis and also covering IRR and NPV. All of them around the invest and appraisal section of CAP1 Finance.